Joining us to talk about the market today, Barry Bannister, Managing Director and Head of U.S. Equity Strategy at Stifel. Alec Young, Managing Director of Global Markets Research at FTSE Russell. And Lindsey Bell still with us, Investment Strategist at CFRA. Lindsey, what stands out to you as we watch these record closes on the S&P and the NASDAQ, with the good news piling up, certainly from the company side?
Yeah, and I think to Mike's point, 2% GDP growth, inflation steady, interest rates maybe coming down here. That is a good environment for this market to continue to move higher. And that's what has driven this bull market to the longest bull market in history, the longest economic cycle in history. And I think it's something that you're going to continue to see. Corporations are certainly, if not, feeling more confident about the situation abroad. They're definitely reiterating guidance, increasing guidance, and this earnings season has really been a great one so far.
Alec, obviously part of the story for how well the market has done this year is a lot of people didn't expect the market to do well this year, and they were focusing in on a lot of the downside risks. At this point, with this run we've had in stocks, with bond yields very low, it's not as if getting a little bit of expected good news out of the Fed is necessarily going to be a major trigger, or do you think it could be?
I think we might be setting up for a bit of a sell the news event, because this is the most widely anticipated rate cut I think I can remember. And we are seeing some bifurcation, so the averages are doing well, but it's very much technology, discretionary. Where's the reliable organic growth? All the global stuff, I could give you huge swaths of the market that aren't participating. Healthcare, energy, most of the commodities outside of gold, industrials, Boeing. So, there's clearly still some risks out there.
Are you saying that those are tells, or are you saying that those are buys on catch-up?
That's obviously the $64,000 question. I think that the big key at this point, we're trading at about 17.5 times forward earnings for mid-single-digit earnings growth. The consensus numbers model in a big hockey stick up heading into the fourth quarter in next year. I think we're getting to the point where we need to start seeing some macro evidence in the leading indicators globally that we are really going to see an acceleration. I think we're transitioning to more of a show-me market. Hope is not a strategy. Returns may moderate from here. You've heard all the cliches, but I know it's tough on feel-good days like this. But I do think it's prudent that people should remember that these are, risk assets. It's hard to see a big downside catalyst. I'll give you that. But I do think that the onus is on the bulls to show that these gains are justified here.
Barry, his history says that the market tends to like the initial Fed rate cut when there's not going to be a recession. Obviously, you never know in advance if that's the case, but the stock market so far is acting like it thinks it's free of the recession risk for the moment. How do you think it'll play?
Yeah, one of the things that I'm noticing is even though the economic risk is receding a little bit, the policy risk has gone way up. Here we are at a 3,000 S&P, 27,000 Dow. The president's poll numbers are up. The Mueller thing's in the rearview mirror. Remember, the beginning and the end stage of any deal is the most volatile period, and he's got to deal with China and Iran before 2020 starts. He's got currency now, and he's probably going to spend it. So you're going to see more policy volatility, I think, over the course of the rest of the summer.
We were just showing this very nifty little data tracker that moved along, showing some of the recent releases we've gotten out of the economy, not just today's stronger GDP number. We got a better jobs report last month. For the month of June, we've been getting firming inflation numbers, better retail sales, better durable goods, Barry. So, I wonder if that's enough to sort of change the backdrop to stocks, no matter what the Fed communicates beyond a cut next week.
Well, the Fed is only part of the story. We're going to get July 31st. The question of September is not as likely as it was recently. Insofar as the approach to the rate of growth, remember, the Fed is still too tight for the rest of the world, and the rest of the world's economy is still very weak. So they're going to answer to a domestic mandate more so than a global mandate, and that still has blowback to the U.S. economy over time. But I agree, the U.S. is doing better than expected, and as a consequence, the market is range-bound.